Welcome back, everybody. Now, today's challenge is about understanding historical price ratios. Now, the document is attached here in the post, and if you open it up, you'll see that for background, we basically say, look, price ratios like price to earnings or price to cash flow, which you hear me talk about all the time in my videos, they can help us determine if a stock is trading at an attractive level, and it can be done in multiple ways. Comparing a stock's price ratios to other stocks, like for example, if Coca-Cola was trading at a 15 price to earnings, which I checked and it's not, by the way, but then Apple was trading at a 32 price to earnings, then what do those two different things mean? But also an important idea is to compare a stock's price ratio to its own history. And for example, if Apple is currently trading at a 32 price to earnings, but their 5-year average is a 28 price to earnings, then that may mean that they're currently trading at a premium to their recent history. And we'll go through some examples of that here in a bit, but before that, here are the action steps I want you to take before we come back together and talk through it. Action step number 1, pick 2 stocks that you're interested in and find what their current price to earnings and price to cash flow ratios are. This info can be found on just about any investment website. Seeking Alpha, if you choose to use that, has them on the valuation tab. Now, action step number 2, compare their current price to earnings and price to cash flow to their 5-year average. Are the stocks currently trading for a premium or a discount compared to their recent history? Next, go ahead and compare it to their 10-year history. Now, this can be done on the Seeking Alpha charting tab. And then lastly, for each of the 2 stocks that you chose, would you consider each stock to be undervalued or overvalued based on their historical price metrics? Why or why not? And then just a couple things to think about, which we'll touch on at the end. What does it mean if the price to earnings or price to cash flow is actually blank or negative? And then lastly, how can historical price ratios be misleading? So go ahead and get started on your action steps right now. You can pause the video right here, and when you come back, we'll go through it together. I'll see you guys then. Did you pause? I'm kidding. Did you actually pause the video? You need to do the work, pause the video, and do the work. Okay, we're back. Now, I'm curious to know if you guys actually found anything interesting through the action steps, but let's go through them together so we kind of get an idea of what we're looking at. So for my 2 stocks, I'm going to choose HSY and META platforms. Now, if we just go to HSY, we go to the valuation tab, we can see from a price to earnings standpoint, they're trading at about a 21 price to earnings. And from a price to cash flow, they're trading at about a 18. Now, if I go back to price to earnings here and I say, all right, price to earnings is 21.43, and their 5-year average is 26.18. Now, what does that tell us? It tells us that HSY is currently trading at a lower price to earnings multiple than they have on average for the past 5 years. And we'll get to what that might mean here in a minute, but first let's look at price to cash flow. So price to cash flow again is at 18.05, and we see that their 5-year average is 18.72. So again, for price to cash flow, HSY seems to be trading at a slight discount to their 5-year average. Now, at first glance, we might say, look, HSY may be trading at an attractive price right now because their price to earnings multiple is lower than their 5-year average. But it's not quite as simple as that, which we're going to get into. But let's go ahead and look at the next stock. So META platforms, if we go to their valuation tab, we see that from a price to earnings perspective, they're trading at a little over 27, with their 5-year average being 26.24. And if we go down to their price to cash flow, we see that they're trading at a 17.01 with a 5-year average of 15.37. So again, at first glance, it looks like META is trading at a slight premium to their 5-year average, which means that from a price perspective, maybe they're not too attractive right now. But again, it's not quite as easy as that, and let's get into that now. And so the first thing we'll do is take a look at the 10-year average just to get an idea of if it's a different story. So if I go price to earnings, price to cash flow, I remove price return, update my chart, click 10-year, and here we are. And you can kind of see right off the bat that the price to cash flow, which is in blue, and the price to earnings especially, look quite a bit lower than maybe their average has been over the 10 years. Well, maybe not so much price to cash flow, but definitely price to earnings, because it's trading at about 21, where for most of this time, it was trading in the high 20s, over 30, And so it's back to the levels that it was at in 2018, 2019. So again, for Hershey, when you look at that, I think it's pretty reasonable to say, all right, from a price to earnings perspective, Hershey is trading at an attractive level from where it's been over the past decade. Because you can easily see that the price multiple is lower than most of the previous 10 years, with some exceptions here in 2018 and 2019. Because remember what a price multiple is. In this case, price to earnings is simply the stock price divided by the earnings per share, which means that the amount you're paying for earnings is lower than it was, say, in 2022 or for 2023. And that's why, in general, people say when the PE is lower, that means it looks more attractive because you're getting more earnings for the price that you pay. And we'll come back to Hershey's in a minute, but first, let's go ahead and look at META. So if we do the same thing for META, and we look at the price to earnings and the price to cash flow, and we go over the next 10 years, or the last 10 years, what you see is that META actually looks pretty interesting as well. Because even though their current price to earnings and price to cash flow multiples were higher than their 5-year average, when you look at their 10-year, it's a different story. Because META was frequently trading for much higher price multiples back in 2015, 2016, even through 2018. So while at first glance it looks like META was maybe at fair value or trading for a slight premium, when you look at the 10-year, it actually looks like it's trading in a pretty decent value range. And so if we come back to our question that says, would you consider each stock to be undervalued or overvalued based on their historical price metrics? So for me, if we go back to Hershey, based on the 5-year average, it looks like Hershey is slightly undervalued. And when we look at the 10-year for Hershey, it was kind of the same story. It was trading at a discount compared to their history over the past decade. Now for META, it's a slightly different story because if you look at the 5-year, it looks like META's trading at a pretty decent value right now or about where they're at over the past 5 years, if not a slight premium. But then when you look at the 10-year, it's a little bit different because META kind of looks attractive compared to where they were towards the beginning of the decade. But let's get to the questions to think about to understand this a little bit deeper. So the first one is, what does it mean if the price to earnings or price to cash flow is blank or negative? And to show you an example of this, let's take a look at Okta. Now, if you go to Okta's valuation tab, you can see that their price to earnings trailing 12 months and projected is both NM, or not measured. And the reason for that is because their earnings are negative. And we can see that in their financials right here. Their operating income is negative, and then their net income is negative as well. So obviously, if we come down to earnings per share, we can see that earnings per share is negative. So if you have a negative earnings per share, then the price to earnings multiple is going to be negative, which doesn't make any sense. And that's why they just put it as blank or NM. And just to understand what that means a little bit better, when you're saying what price are you paying for what earnings are you getting per share? Well, when a company has no earnings, it means that they're literally losing money. So there's no reason to have a price to earnings multiple because they're not actually making any money. And now if you wonder, well, why would someone buy a stock of a company that's not making any money? Well, there's a lot of reasons for that because, again, earnings are based on kind of GAAP principles, the general accepted accounting principles. So there's a lot of ways you can have negative earnings even though you technically are making money as a company. Amazon did that for years. But then also it's because people see the future growth potential of a company even if they're not profitable at the beginning. But anyway, let's get back to the last question. How can historical price ratios be misleading? And I'm going to show you two different ways that this happens. And the first one, I'm going to use McDonald's as an example. So if I look at McDonald's and I say their price to earnings is 24.38 right now, and their 5-year average is 28.4. So again, on the surface, it looks like McDonald's is trading at a slight discount to their 5-year average. But then if we look at the 10-year for McDonald's, what we see is that it actually looks like it's trading at about fair value compared to the general average of what it's been over the past decade. Now, if you go back to 2020 and 2021, it was at a much higher multiple back then, in some cases over 30 to 35 PE. But part of the way that price ratios can be a little bit misleading is they don't give you the context of what was happening from a macro environment at the different points in time. And let me show you what I mean with McDonald's. So even though most people think McDonald's is a burger company, when you actually look at their business and how they make money, they're really more of a real estate company that licenses the McDonald's brand. So what that means from a stock perspective is McDonald's is kind of like a REIT, even though they're not technically a real estate investment trust. So when you look at the high price to earnings multiples back in 2020 and 2021, you have to remember what was happening at that time. That was around the time where we had COVID and the global pandemic, and rates were basically down to pretty much zero. And you might be thinking, okay, well, what does that have to do with the PE ratio? Well, remember, the PE ratio has two factors in it, the price and the earnings that the company are making. So if we take a look at the price return and the earnings per share for McDonald's, we can see that in 2020, the earnings per share for McDonald's really dropped dramatically. And it makes sense as to why. We had global lockdowns. The economy was really a mess for a while because everyone was in their homes or really just not having the same type of activity that we would in normal times. But what you can also see is that McDonald's stock price also went up at the same time. So you had this combination where the price was going up and the earnings were going down, which means the price to earnings multiple was going up a lot. And that's why when you look at just the price to earnings ratio here and you compare it to the 5-year average, it doesn't tell you all the context of what happened over that 5 years. Like there may be a reason why the 5-year average is higher than the most recent PE, but that doesn't necessarily mean that it's going to go back to that level. And that brings me to the second way that historical price metrics can be a little bit misleading. And let me go back to HSY and META. Now remember, when we talked about HSY, we said from a price to earnings perspective, they were trading at a slight discount compared to their 5-year average. And that for META, it was basically the opposite. They were trading at about fair value or actually a little premium compared to their 5-year average. But one thing about price ratios is that they don't tell you the growth that you should expect for that particular company. Because now if we compare the growth measures for HSY and META, we see that revenue growth for HSY is about 1.5%. Earnings per share growth is less than 4%. Their projected earnings per share growth is less than 3.5%. And even just looking at the free cash flow growth, it's actually negative year over year. So while HSY may be trading for a slight discount, we also have to understand that their business growth is really struggling right now too. Whereas if we compare that to META, we can see from a growth perspective, META is really good across the board, with their revenue growth over the last year being over 24%. Their projected growth is over 16%. Their earnings per share growth is 128% year over year and 41% projected for the next coming year. And all the way down the line, if we look at free cash flow growth, it's over 63%, and operating cash flow growth is over 40%. So you have a company that, yes, it's trading at maybe a slight premium to what it's been over the past 5 years, but the growth rate and the growth expectations are way higher than HSY. So the questions we have to ask ourselves whenever we see this is, okay, historical price metrics are great to give us just a general idea of where stock is trading, but we still have to look at their growth and expectations for the company to know if it's an opportunity or not. And remember, just because HSY's growth expectations aren't all that great right now, it doesn't mean that they won't be or that it won't be an opportunity. And so those are the things we have to dig into as investors. These historical price metrics are the first step to say, hey, there might be an opportunity here, but we still have to do the work to understand if the business outlook is looking attractive or not. But one way that I use the historical price metrics is to monitor stocks that I already think have really good businesses, just to see whenever the price comes down to a point to where they look attractive to buy. To me, that's where they're the most powerful once you've done that business work up front. All right, so that's it for this challenge. Hopefully this helped and you get a better understanding of what historical price metrics are and how you can use them to find stocks that you're interested in. If you guys have any questions, put them down in the comments. And yeah, hope you learned something. See you in the next one. Peace.